Good afternoon and welcome to AMP Bank's Credit Webinar. Hope you're all doing well today and joining us virtually from around the country. Thank you to all our brokers and advisors for joining us today, and thank you also to our aggregator partners who are also joining us today, and we appreciate the ongoing partnership and continued support. I'm Michael Christofides, General Manager of Home Lending at AMP Bank. To start, I'd like to acknowledge the custodians of our land. I'd like to pay my respects to the First Nations peoples. That's to acknowledge the Gadigal people of the Eora Nation, who are the traditional custodians of the land on which I'm located here in Sydney, and the elders of all the lands where you are all dialed in today. I acknowledge those elders past, present, and emerging. We've got a great lineup this afternoon. I'll start by talking about our leadership changes and structural changes, as well as our strategic direction. Erin Phillips, Head of Lending Operations and Client Assist, will then share a bit more about the team, latest enhancements, best ways of doing business with us, and support for our clients. David Melville, Senior Manager, Mortgage Credit Risk, will then give his update on risk, sharing market reflections, a lending perspective on risk, and policy changes. And we'll then finish off with some Q&A with Erin and David before wrapping up. I encourage you all to get your questions through on the chat. Please just type them into the Q&A box and we will get to as many of them as possible. Importantly, on screen, you'll see the event codes for your CPD points. We'll also pop them in the Q&A chat for your reference and remind you again before we wrap up. I'll just leave that on there for a second for you to take note. But we will now get started. So I'll begin by sharing some updates to our team structure and give an overview of our strategic direction. So in terms of the home lending business and our AMP Bank strategy, AMP Bank recently appointed Sean O'Malley as its new Managing Director. He's been leading the bank in an acting capacity for the last few months and remains focused on all the important work that we're doing to enhance our service and offer and proposition. I've been appointed as the General Manager for Home Lending. I've been at AMP Bank for 6 years, and I'm also focused on continuing to enhance our lending offer and experience. In a structural change to our organisation, we recently moved to end-to-end business lines. That means that operations, distributions, product and change have all come together under one business unit reporting in under me. As part of these changes, Adrian Smith, our Director of Distribution, and John Skilbeck, Head of Intermediary Distribution, will be departing during June, having both made outstanding contributions to the growth of AMP Bank. Our focus is on ensuring a smooth transition, and we're currently recruiting for a new Head of Intermediary Distribution and Governance, and we'll be announcing who that is shortly. One of the things I think was really important for us in terms of our go-forward strategy is about improving our brand awareness and consideration. I think the fact that AMP actually has a bank has been one of the best kept secrets for many years, and we're looking to change that. So that means we'll be looking to advertise a lot more in broker and advisor industry press, as well as in customer press. And that's really just about letting the broader market know who AMP Bank is, what we're all about, and of course educating the market about what our proposition actually is. Next, our focus will be about expanding our contestable market. We've been around for about 22 years and have done a great job, I think, in terms of building up our portfolio in owner-occupied and investment segments, but we're looking to do more. And what I mean by that is we're looking to get into segments that we're already in, but want to improve the proposition. And so a couple of examples where we'll be looking to invest are areas like first home buyer and construction. And keep an eye out for that. There'll be more announcements about those changes coming later on this year. Another element to the contestable market expansion is we have a pretty strong presence in all states, but most notably New South Wales. One of our focus areas going forward will be about increasing our presence in Victoria, especially given that's a market of importance to us and important to our brokers. And we'll be announcing some changes in that market shortly as well. This one's pretty important, improving our lending origination capacity and ease of use. I refer to that as being the key that's going to unlock the future success of AMP Bank. We've already been investing in this for the last couple of years, and I'll let Erin talk to some of the most more recent changes that we've made. But we will continue to invest in our origination capacity and ease of use. This effectively means that we'll be making investments in automation, investments in digitization, and investments in additional resources to help ensure that we open up the capacity of our back office. I'm sure many of you are dealing with capacity constraints. It's a pretty busy market at the moment, not just for lenders, but for brokers and advisors as well. And so we're very focused on continuing to invest in this area of our business over the next 12 months, but over the next few years as well. And the last element of our strategy that I wanted to call out was about uplifting our customer experience and digital capability. This is about investing in key moments of truth for our existing customers. In addition to item 4 there, in terms of improving our origination capacity for new customers, this is about investing in existing customers in things like increases and variations. And again, this will be something that we'll be focused on over the next few years. I would now like to hand over to Erin Phillips, who'll give us a bit of an update on recent enhancements and future enhancements to come. Thank you.
Thank you so much, Michael. I wanted to say a very big thank you to all our broker, advisors and aggregator partners out there for taking the time out today from what is your very busy schedules and running your businesses. So thank you so much for joining, and thank you so much for giving me the opportunity to come and present again. My name is Erin Phillips and I lead the lending operations teams for AMP Bank. And I'm coming up to 2 years later on this year with AMP Bank and have seen a story of, I think, improvement in our service offering and a continual commitment to continue to do so. So for those who have heard me speak again, thank you for your patience in allowing me to speak again. It is definitely a privilege to be able to come and share what we are doing from a service and operations perspective. So the first slide I wanted to talk to is, and I think I always like to start with this slide, it's really getting you to meet the team. So you've heard from Michael, you've met Michael, you've had an intro from myself. Really important though to share how we operate and how we service your clients and our mutual clients' applications. And so we are a true end-to-end lending operation, a true end-to-end lending business. We have, and that includes the credit approval space. We've now expanded from 2 to 3 credit approval teams because we are growing. We do have a strategy aligned with growth, as Michael mentioned. We're actually looking to expand to a 4th credit team shortly as well. So watch this space, and I'll talk a little bit around our investment in people in my coming slides. We also have a credit capability area, and this area is very, very important to us because this is where we commit to uplift and training of our people, and that's from both a technical and a client and customer service perspective. But really importantly as well, that team also work on what strategies, what automation and technology can we use to be always uplifting and improving our offering. So that's a really vital part of our team. We also have within our team our existing customer variation and restructure teams, as well as our hardship area and our arrears management or client assist team. So now that you know our team, what do we do and what do we offer? I feel like this one is really our commitment to you in how we operate day to day. Our mission as a team is to be communicative and helpful, and we really want to make sure that we're delivering consistently, high quality and fast turnaround times. And I think for me, the most important one is around that consistency and also communication. And so within our team, we've got about 120 team members, 90 of which are based onshore here in Sydney. And then we have a team of about 30 through our partner Tata Consultancy Services over in India. And all of our credit analysts and all of our credit decisions are based onshore. And our commitment to you on that is we will always pick up the phone when we receive your client's application and conduct that first initial assessment conversation over the phone. And that is so critical because we want to make sure that we're not only looking at what the numbers are showing us within the application, but we take the time to understand the needs, the requirements, and how your client needs to be serviced. And we find that much of the goodness comes out in that really rich conversation. So that's why we commit to that one. We'll also contact you if there's any clarity required or if we have missing information, etc. We do pick up the phone again. So we are at A&P known very much for great products, great pricing. We are really building out and looking to strive to be known for great service and great communication as well. We also partner, we have some very strong partnerships that we value in our lender's mortgage insurer, Genworth, and as well with FMS, who are our settlement agent. We're working especially close with FMS currently. As with most of us and the rest of the market at the moment, they are experiencing significant volumes, but we have a particularly strong relationship with FMS, and they are on a big customer experience journey that's aligned to our strategy. So the commitment in still maintaining the service from a A&P Bank client perspective is certainly there and is strong, which is great. And the other thing just to share, because it's relevant to the environment and the pandemic that has been the last year, we're really quite proud of how agile our lending operations team have been able to be and have continued to be. We had a little head start in that at A&P Bank. We are very big on flexibility. And so prior to COVID-19, we already had around about half of our people working from home, not necessarily every day, but several days a week. And so it was really quite easy and straightforward for us to be able to flex. And so to this day, we still have around about 95% of our people who service your client applications working remotely or from home. So it's really put us in good stead throughout this period. The next thing I'd like to share is a little bit around our strategy aligned to credit capability. And one of the first things to talk about that we've done this year to date is just investment in people itself. So capability aside, we have so far increased our credit analyst population by 1/3, so by an extra 1/3 this year to date. And in addition to that, we have spent a lot of time uplifting our credit capability training. And we have done that by partnering with Moody's Analytics, or as like myself and some other people I'm sure listening in, you would know that as the Amiga training that we all did back in the day. And that has really put A&P Bank credit analysts in really good stead to have a qualification that gives them really strong knowledge across what they're doing, across the credit space, also across self-employed and more complex applications as well. And we also have an internal course that we run for our team and our new inductees called Credit at A&P. So not only are we covered by sort of that industry lens on credit and lending, but we're also making sure our people are confident with our policies, processes and systems internally, and really investing, having a formal training uplift program around that has really led us to be able to uplift the capability of our people in a positive way. We've also modernised and simplified our delegation framework. Dave might correct me on this, but I think we had around about 9 different delegation levels. We've reduced and streamlined that down to 5. And also importantly, within those streamlined delegations, or the most important thing about it, was that we removed a series of limitations within those delegation levels. So the whole premise was to open up and empower our people that if you have a 3 million or a 4 million delegation, you can do just about anything, you know, within risk appetite in that delegation. So you're not restricted and you fully are empowered. And then David, who you'll meet in a moment, David and I work very, very closely on continuous policy and process improvement. I was going to say we do that monthly. We probably do that far more regularly than monthly, but monthly at a very, very minimum. And that's important that we seek feedback from both our brokers, advisors, as well as from our distribution team in putting forward, you know, what are the great things out there in the market that's an opportunity for us to play in as well. So that's some of the recent work we've done in that credit capability space. Next, I was going to share with you what I really get excited about, which is our journey to become a more automated, seamless service experience. And we're using a lot of technology and digital capability to be able to land that. And so what we've done in the last year, or most recently, is several enhancements for our automated credit decisioning platform. Ultimately, we prefer to and want to ensure that we can get as many of our clients as possible automatically approved, because if we can reduce the number of manual assessments required, we get more straight through approvals and a faster overall turnaround time for yourself. So we're playing with rules in the background to make sure that we're being, risk compliant, but at the same time, really making sure we can look at things differently to get that fast customer outcome. One thing that we did recently, and for those who write business with AMP Bank may have noticed, we have streamlined and enhanced our approval letters. That was one piece of feedback we got from our brokers and advisors and our BDM team as well, that we didn't do very well. And so we've made them more dynamic and more specific to the conditions of the particular clients, and have uplifted that capability this year. As well as that, we have spent some time automating our BOI and AML processes, and that is really laying the foundation at this stage, particularly through the use of DVS, the Documentation Verification Service. And in addition to that, we just recently went live with the supporting documents upgrade through Apply Online. And really the whole premise of that is to ensure that we get everything that we need up front as required, and removing sort of rework within our business. So already just weeks after rollout of that supporting documents upgrade, we're already seeing efficiencies within our operation off the back of that, which is a great outcome. Another one that we did a little while ago now was e-sigs on loan documents, which has been around for some time, but really exciting. And I know from feedback I've heard so far as well this year is, when are you getting e-signature on your application form? So I can commit to you that is already in development. It is in train. We are looking to have that out later this year by September. So that is not far away at all. A couple of other things we are making available through Apply Online is the ability for brokers and advisors to have resubmission at your end. At the moment, we don't have that functionality, and therefore it creates the need for a rework within the lending operations team. We're going to give you guys the ability to make certain changes within the application, and we'll be able to respond to them far more quickly and effectively. And then we're going on the journey for full VOI digitalisation by the end of this year, which will be really exciting. It'll mean we need reduced documents. It will also mean that for those applications that don't pass through DVS, which is our digital means of conducting verification, we will also have an alternate automated way to help assess those applications. So next slide really talks about it's a basic overview really of our credit appetite. So what loans do we accept, and what clients really fit the mould for AMP Bank? So in terms of acceptable loan purposes, I would say AMP are a really simple bank. We do all of the things that you would expect. So owner-occupied investment loans, purchase or refi, construction as well. We do, and we have two different alternatives or options with construction. They can be submitted as one application with land and construction as separate splits, or we can accept two applications, so a land loan and then a standalone construction app. And we have, through some feedback on our construction loan process, created an FAQ guide on how AMP conduct construction loan lending. And that can be made available on the distributor centre or from your BDM. So if you are interested in finding out a bit more about that, please do hunt down that AMP FAQ guide. In terms of our clients, so we're looking at all the sorts of things you would expect: PAYG, self-employed and non-trading companies and selected trusts. And then when it comes to what LVR we go up to 90% plus LMI. And obviously there's several characteristics there that we take into consideration with that in relation to the location or the security, our loan size and loan type as well. And there's lots more information around those items as well on the distributor centre. Loan structures as well. So similar to what I said earlier, exactly what you would expect. P&I interest only, variable or fixed. And then as well, we do combinations across those structure types as well. My next slide talks about what is the best way of doing business with AMP Bank and how can we get the best outcome for you, because that's really what we're here for, is to service your clients and ensure that we get the best outcome and the fastest approval and settlement for you. And so going back to what I was talking about earlier around our recently upgraded supporting documents capability, the use of those minimum supporting documents, I think, is really, really critically important. We qualify that internally as our incoming quality of submission. And if we can get those right, we're almost guaranteed that straight through STP process. If we don't have that right or there's issues, then it just creates that back and forth. And sometimes I acknowledge there are documents being requested that for whatever reason may not be able to be provided. If that is the case, then I would recommend you request an exception in the supporting docs card and just let us know why that is not able to be obtained. I think sometimes we see blank pages or other items uploaded for want of not being able to provide what's needed. But if we just put an exception there, that would be preferable. Next one is around verification. So use DVS if you can. It's faster, quicker, and now through a recent change requires less documentation. We only need a copy of driver's license, doesn't need to be certified. Let us know around comprehensive credit reporting, and what I mean by that is if there is a condition asking for that and it's in CCR, once again, just let us know. We are making a system change, so that won't be required of you anymore, but in terms of having to explain that. But I think for now, if you can let us know, that would be very, very helpful. And then it's around tell us your client's story. And I always go back to sort of the old credit analogy that if you are in the shoes of a credit analyst or a credit manager and you're able to get 90% of the way there through all the information provided to you, then you're already basically approved. The only remaining 10% really is a verification of that information. And yes, there are the numbers that we can see, and we can see all the different C's of credit through the submission. But if there is information that you can put in your broker or advisor notes that tells us the story, that's always very, very helpful. And then when it comes to more complex scenarios, credit scenarios, your BDM can help with that. We also, within our higher delegation team, have a series of experts who can help support our BDMs through credit scenarios as well. And I think the last thing I will mention in relation to that is, although everyone comes in to do the very best they can within the lending operations team, to make sure that we get the best outcome for you guys, I do absolutely recognise that things are urgent. It may be someone's fault, it may be no one's fault. It's the nature of the business that we work in, and so you do have the ability to speak to your BDM around escalations if they are required as well. My next slide really talks to some of the things, and I've spoken to my team, and I won't go through all of them here, but just to share with you, what do we often find missing in submitted applications, and really sharing this not as a critique, but just as a how can you help us to help get that fast straight through approval. And they really fit under the headings of undeclared living expenses and income calculations, things like bonuses, BAS statements not being provided on self-employed, and those sort of items. These are the ones that the feedback from my team have been probably the most consistent and regularly missing. And so these are the ones that if we can really nail and take note of, will certainly help with improvement on quality coming in and therefore faster turnaround times. And just lastly, the last thing I wanted to cover was for any of you who may have attended our last AMP Bank webinar, I provided an update around how we supported our clients through repayment pause. And now with repayment pause having come to an end as of 31 March this year, I just wanted to share the ongoing support and how that sort of ended, not the support ending, how repayment pause ended in March, and then the ongoing support and how we're tracking with that. So in terms of the number of clients we assisted, it was around about 4,600 clients, which is about 11% of the AMP Bank loan book. And 85% of our clients have since been able to continue back to normal regular repayments, which is a fantastic outcome. We still have about 145 repayment pause clients that we are continuing to assist through our BAU hardship assistance. And we are continually expanding our hardship offerings in partnering with organisations, non-for-profit organisations such as the Good Shepherd and more recently Way Forward as well. And so we're really proud, I guess, as a bank and as a business of how we've been able to support these clients, and also with the close of repayment pause, how we've been able to uplift and expand our offerings to clients in hardship, whether it be repayment pause or otherwise. So thank you so much for listening to me speak. I will now hand over to David Melville.
Thanks, Erin, and thank you, Michael. I'm sure everyone got a great deal out of what Erin just said. That was really insightful. Yeah, my name's Dave Melville. I've been with AMP Bank for just on 10 years. For those of you who've been around for a while, so I started managing the collections, worked in operations, and managed the credit analyst for quite some time, and have been in risk for excuse me, the last few years. So kind of been across the whole end-to-end package there, which is great for me. For those of you that dialed into the webinar last time, you know I like to put a little quote in here, and last one was I put in there was from Teddy Roosevelt. So this time I chose Warren Buffett. We all know how successful he is. And obviously you can see there it says risk comes from not knowing what you're doing. Yeah, part of my job, owning credit policy and working closely with operations and distribution, and that is, knowing what's good risk, what's bad risk, what's middle of the road, where we can put in and accept exceptions and overrides, excuse me, and how that helps shape our policy and moving forward. So, where do we get this knowledge from? We participate in forums with the Australian Bankers Association, with the Australian Retail Credit Association, and I think very importantly, and I'm sure you all agree, is listening to you guys. So the feedback that you give to us around what we're doing well and what we're not is certainly something that's very important to us. And I'll touch on that a little bit later when we get to the end of the slides. So just working through some of the credit risks and the policies and procedure things. Some of this you may have seen last time, but I think it's really good to restate. So when we're working with self-employed clients, we've got guidance in place, where we can accept the latest year results and kind of move outside of what our typical, excuse me, policy is. Where if you have a significant increase in profitability from one year to the next, typically we would apply 20% year-on-year growth. But if you can work on getting some updated documents like 6 months interims and BAS and whatnot, we have that flexibility to apply the most recent year's results and kind of move away from that 20% piece. The other thing which I'm hoping you saw in recent weeks with some comms is that we've removed the requirement for trading account statements as part of the supporting docs for self-employed clients. For the time being, we're still going to ask for BAS, and we'll work through the supporting docs checklist just to get that updated, and hopefully that'll help with some of the missing information requests that potentially coming out from operations. Moving to COVID impacts, again, the valuation protocols have been in place since last year, and that was a really good really good example of where the industry came together. So the Australian Property Institute partnered with all the banks, and we really came to that quite a quick decision on how to do virtual valuations and how all the banks work together to bring that into their policies and procedures, so that where policy sort of demands that a full val is required, we're making it easier for the valuers to do it, particularly in cases like now where you've got Melbourne lockdown. Most of the firms, or if not all the firms, have already instituted that protocol again, which works really well. The other thing that I'll work with, and I'm just starting to give it some thought now, and we've seen some of the other banks do this, is how we can work with self-employed clients and understand what the impacts were for 2020, and looking at, say, 2019, what the impact was for 2020, and kind of moving forward. And that'll be similar principles to what I talked about earlier with the 20% year-on-year growth. So it's understanding how they've moved through, what was probably a challenging year potentially for them, depending on what industry they're in, of course, and what we can get to know to now understand that they are back on track, and not necessarily ignore, but place some less credence on what happened in that last year and kind of move forward to make sure we get a good outcome, not only from the bank from a risk perspective, but also obviously for the client as well. Cash out, supporting docs. We've recently approved adding a client stat deck, or in some cases a letter to support the application, where they might be struggling to get what our standard supporting document evidence might be. It still needs to be mitigated, and it's not a standard. It'll be by exception. So we'll communicate full details to that in the coming weeks, along with some other changes that we've got coming up. But again, that will allow not only you guys in dealing with the clients, but also the credit analysts in the operations team a little bit of flexibility to make sure that we're not going to lose, what probably what is a very, very good deal, simply because we're sticking tough on what our documentation should be. So that flexibility and those comms will come out fairly shortly. The next thing is valuation mix. We worked quite hard on this sort of through last year, and it basically centred around the kind of the middle of the road valuation. So we call it a desktop or an EVR. I'm sure you guys all know that. Typically, our valuation mix up until November last year, when we put the change in, was AVMs, or those electronic type valuations. They're around 10% of our volume flow. The EVRs were kind of around 25 to 27%, and the rest were made up of full vals, being short forms or long forms. So what we looked at was allowing desktops to be done in a subset of our medium risk postcodes. That was 66 new postcodes that we rolled out there. Excuse me. And then also within again another subset of mortgage insured approved postcodes, so we can actually accept EVRs up to 90%. So what we've seen recently is the mix has kind of shifted to, as you can see on the slide there, desktops are now comprising sort of 40 to 41% of our valuation. So hopefully you're seeing that in improved turnaround times for your clients when you do order those up front. Next thing is, again, we're working on how we can improve the warning messages in Lodgement Centre. Just to kind of help you, so even before the deal goes through the gateway, to help manage your submission quality and just flag where there might be some issues with our adults, with some of our policies. We haven't looked at it for a while, I must admit. So I think it's important for us to work through that. We've been engaging a little working group with the distribution team and people from Aaron's team as well. So I'm pretty confident that when we get that rolled out, that'll include some warning messages around DTI and a whole bunch of other things that we've got running now that will, improve the submission quality from you guys, but more importantly, improve the turnaround time, reduce requests for more information and whatnot as the deal comes through. So I'm quite excited about that piece of work. Next one is another proof of concept that we're going to trial, and we're just about ready to roll this out. So we're partnering with CoreLogic, and what this will do will enable us to manage our concentration risk and our hazard risk on security properties. So with that, the first big concentration risk, our policy is that, say you've got a building, like this one in Circular Quay, if it happened to be an apartment building that had, say, 100 units in it, our maximum risk appetite for exposure in that building is 10 units. Now, at the moment, we haven't got a real robust system to manage that. And then the second bit from hazard risk management, that would be things like Opal Towers and Mascot Towers have got structural issues, other ones with the band aluminium composite panelling, and any other kind of hazard type of risk that is associated with a particular building. So these will be centred down to specific addresses. And what we'll do is we'll have a database within the Valex system so that when a valuation is ordered on one of those addresses, it'll ping an alert to us. And then we can go and have a look and see what it is. Now, it's going to be a fluid database, of course, because we'll have discharges in some buildings, which means that we will be happy to lend there. Other ones we don't. So I think the benefit to you guys might be that, unfortunately, if we get a decision that we don't want to lend anymore in that building, at least the valuation hasn't been ordered. It might stop you from submitting the application with us, which is an unnecessary bureau check on the client. So I think we'll work this. As I said, it's only a proof of concept. We'll run it on for 6 months to do a bit of a test and learn to see how it works for us. And we'll certainly be seeking feedback through the distribution team and obviously via you guys to understand how that works well for us. Responsible lending, well, that's been around for ages now, and it went back to the government for debate on the 11th of May. It's still up in the air. We know Pauline Hanson and a few of the other politicians there aren't backing it. So it's still kind of let's wait and see what's going to happen. I have said in the past that I don't know that it would necessarily change the dial a great deal for AMP, but depending on what the outcome is and how it may create almost like a ripple effect on some of the other regulatory guides that we look at, like things like prudential lending for mortgages and credit risk management. If that changes, then we may need to shift for that. But that's kind of still waiting to see what's going to happen with that one. Climate change. I think I may have touched on this very briefly in the last webinar. So we're now at the point where APRA has come out with a consultation practice guide called CPG 229. And it's in that phase now where they're seeking feedback, and we're working with the ABA. So myself and a couple of other people from AMP are on a working group with the ABA, and understanding what potentially the impact can be for us. For AMP, it may not necessarily be too big of an impact. The big four plus Macquarie, who do a lot more in-stay lending, I think will be far more impacted as you look at the different kinds of risks that come with climate change. You've got physical risks, so that's the risk to the property itself. You've got transition risk, which is like the desire to get to zero net emissions by 2050 and how that might impact certain industries, whether that means job losses and whatnot. And obviously that flows across the industry. People lose their jobs, so it's interesting to see where that one comes. Again, going back to the big four plus Macquarie, they're undergoing at the moment what they call a climate vulnerability assessment. So working quite closely with APRA on that one. The word is that that's going to come across the industry in full, but I'm not sure exactly what the outcome of that's going to be. So this is probably going to more be about how it might shape what our policy does in 2022, with the expectation that this practice guide will come out by the end of the year. The other thing which I thought I'd touch on, which you may find of interest, is APRA reached out to all of the ADIs, so lenders, authorised deposit taking institutions, late April, and seeking some information. So the information we had to provide by the 14th of May, that was things like they wanted a copy of our risk appetite statement, they wanted a copy of what our management limits are and how we manage different risks through the business. They wanted a copy of our serviceability policies and what's changed in the last 12 months. They also sought our exceptions and overrides policy and what we've changed in past 12 months. And they also wanted copies of some board reports to the board itself or to the board risk committee, excuse me, just to understand and look at how we are managing the trends on what's happening in the industry at the moment. You know, obviously they're very concerned with historically low interest rates and house prices continuing to accelerate. So we provided that information well before. The second thing that they were asking was board assurance by the 18th of June. So what that was, back in 2018, a lot of you may remember when APRA removed the hurdles or the caps on investment lending and interest-only lending. All the banks had to provide certain assurances around sound residential lending standards and practices. So what we had to do was, well, what APRA's doing is seeking reassurance from all the boards that we've done another review and that the board are still satisfied that the assurances given then are still in play. So that was quite a large piece of work. We've managed to have that ticked off by the board, and we will get that off to APRA by the due date. So the last thing I think is, you know, what we can do better. I know Erin kind of touched on it in her presentation, and what I would encourage you to do is have a look at the survey, and Michael will also touch on this in his closing remarks. But you know, one of the questions there on question 6 is how can we improve your experience with AMP? You know, that cuts across a whole range of things around distribution team or whatever. But for me, more importantly, you know, where are we at with policies and procedures, and you know, what do other banks do that you think are doing a little bit better than us that we might be able to leverage off? So, thank you very much.
Thanks very much, David, Erin. Great presentations. Thank you both for pulling that together. We've had a number of questions come through. This is the exciting part. Some of those questions have already been answered in the background, so we'll just deal with the ones that haven't. Some of them I'll group together as well. And David, maybe if I can start with you, I'll fire sort of 2 or 3 at you.
Sure.
Can we do business names? In other words, partnership ABNs?
We don't lend to trading businesses.
Okay. Do you have a maximum DDI? This is from Clifford. Do you have a maximum DTI you will accept on a loan?
Oh, we've got a few rules in place. So the absolute max cap on DTI is 8 times. So anything above 8 times is unacceptable. And then you've got different rules that kind of sit with investment lending, where it's if it's over 6, and we've got a little bit of a NMS hurdle in there for $500. There's a bit of LVR hurdle in there. We used to have the same for owner-occupied, but when we managed to bring our DTI levels down into within or at close to appetite, we made a quite little separation from owner-occupied. So owner-occupied now can go to 80, and we also reduced the servicing hurdle on that. But yeah, so there's a number of different hurdles that we've got around DTI, and that's part of what I'm expecting to do with those warning messages that I referred to before.
Yeah, and I mean, if I can just add to that as well, I think DTI is an important metric, not just for us, but for all the lenders. And it's really just about trying to balance our portfolio and making sure, as David said, that we stay within appetite. Next question was around self-employed income. You touched on this, but just to answer the question, how does AMP view self-employed income?
So it's 2 years in the business. Excuse me. Typically, we want 2 years financials. We don't average, as I touched on before. We have a policy in play where if they've had some significant growth, typically we'll apply the 20% year on year. However, if we can come up with some of that other documentation I referred to before, and it is covered in the policy section on the distributor site, then we have that flexibility to go with the most recent year and not necessarily 20% on the prior year to that one.
And I'll ask you one more, Dave, then I'll give you a break. Does AMP have a common debt reducer policy?
So we do. Common debt reducer, we apply to non-spouse partner situations. So, if it's siblings that might have an investment property, then we would all apply common debt reducer to that one. The decision we made kind of goes hand in hand with the benefit piece on transactions and that sort of thing as well. So if it's a spouse, partner and a household perspective, We don't apply common debt reducer where, say, the husband or the wife might have a loan on their own. Similar with, we don't reduce the living expenses as well. So if the non-borrowing spouse or partner, we need their income to look at it to help support it from a household perspective, then we typically need them to come in as at the very least as a servicing guarantor.
Okay, very good. Thank you. Erin, I might ask you a couple,
Sure.
if that's okay. First one was around, could we get the living expenses ordered to match on the calculator and on AOL?
Yes, very good question. I think that's something that we have looked at through our lending optimisation program, and something that is on the list, certainly, for us to make sure that that becomes a more seamless experience. So watch this space and, yeah, we'll make that happen.
Good stuff. Next one's from Rodney Ross. Do you have a fully assessed pre-approval?
That's a good question. We get asked that one all the time. And I think the short answer is yes. And the reason why that is yes is we've acknowledged that the market that we're in at the moment, we see auction clearance rates, we see the amount of people turning up to auctions. So we've acknowledged that, and now we operate as full assessment on pre-approvals. Certainly we prefer to have a contract of sale or security property known. That is the preference to get the best turnaround, but yes, we do conduct full assessments.
Excellent. Next one for you, Erin, is from Mark. For clients who took a repayment pause, did the ongoing loan repayments increase once they resumed payments to make up the shortfall, or was the loan term extended by the repayment pause period?
Sure. So it depends on that particular client's situation. Here at AMP Bank, we really worked with each client. We had a customer-sized problem. We were lucky that we were not dealing with what the big four bank were in hundreds of thousands of clients, and so we made a commitment to call and have a conversation with each individual client and really understand their particular situation, because I can tell you through the feedback from the team and listening to some calls myself, the situations were so broad and varied. But the common practice, unless there was required for us to have a look at the loan term, which would be done through a restructure and go back through our credit processes. But the standard procedure would be that we would capitalise any arrears throughout the repayment pause period onto the loan, and so effectively that would increase repayments. But before just blindly doing that, we assessed every client's individual situation to see whether a restructure might be a better alternative. For example, whether it was a conversion to interest only or whether it was looking at an extension of loan term. It really depended on the individual's customers' circumstances in terms of the solution that we provided them.
Excellent. All right, thank you. I'm going to come back to you now, Dave. Again, some of these you've covered, but let's just close them off. Will you take 1 year tax returns for service?
It's not standard policy. So if they've only been in business for 1 year, it would have to be mitigated as an exception. I'm not saying that we absolutely wouldn't do it, but we would need to look closely as to why. But that goes back to that piece I touched on where if the most recent year was far and away better than the prior year, and we get some additional documentation to support that that is going to be ongoing, we can dispense with the 20% rule and just look solely at that most recent year.
Yeah, and the next one sort of connected to that. Will you be introducing a true 1 year financials assessment similar to ANZ anytime soon, even for only up to 80% LVR?
It's not on the radar.
Yeah. Okay, this one's had the most votes and it comes from Mahish. Thank you, Mahish, for your question. And again, I'll just encourage any others that are, we've got another sort of 5 to 10 minutes left. So if there's any other questions, please shoot them through in the chat. Valuation policy is another area that brokers would like us to have a look at. Brokers are provided upfront valuation access. The system usually determines the type of valuation, desktop or short form or AVM. However, when the file goes to assessors, they always order full valuations. Hence, the applications are always delayed, particularly when investment properties are involved. Why not accept the core logic valuation completed upfront?
That's a good question. I have actually, in the past couple of months, had a chat to a handful of people, credit analysts, to understand why they may have escalated a desktop VAL to a full VAL. So hopefully that's addressed that with those. The rules that we put into Valex and the hub to drive those outcomes are our rules. So ideally, yes, we should be accepting what the valuation is. I guess I'd kind of put a little rider on that. So in the hub, for those of you that use it quite a lot, you'll see that there is a section in there that talks about, are there multiple securities? The reason we introduced that, and that's been in there for a while, the reason we introduced that was we'd found in the past, when that functionality wasn't there, that where you had a higher debt and multiple securities, that what some brokers were doing was dropping the loan down and apportioning it to the size of that particular property. And what that had done in those times had actually driven the wrong result. So it might have allowed an AVM or an EVR when you look at the total debt, it demands that we have a full VAL. So I just encourage you, when you're having a look through there, to use multiple security if that's a factor, and then it should drive the right outcome every time.
Good
if
advice.
I could just add to that one,
Yeah,
Michael,
go ahead, Erin.
it is certainly on our roadmap that we have opportunity to enhance and uplift our valuation process. And we are looking at full Valex integration. We have a degree of integration through logic and rules, but certainly it has been identified and called out as something on our automation roadmap to further uplift the capability.
I'll just add one more thing, if that's okay.
Yeah.
Yeah. So I met with Michael's team, all the BDMs, on Friday, and that was another good example of some extra things we can look at. If an EVR comes in and is a little bit low, whether or not we could put some functionality into Valex to allow that to be upgraded without having to come through our Val admin team and whatnot. So there is some things that we're looking at behind the scenes to help make that experience a little bit better for you guys as well.
There you go. Great question. Thank you very much for that. A couple more policy ones for you, Dave. Does AMP take maternity leave income of sole traders?
Oh, that's a good question.
Might have to come back to that one.
Yeah, I might get Sean to actually have a look into that one. We can answer that one a little bit later.
All right, we'll come back on that one later. And I know you'll love this one. This one's from Mark. What is AMP Bank's cash out policy?
So cash out up to 100,000. It's basically just on the declared purpose. If it's over 100,000, we like to get some information on, or some supporting docs to say this is what the client is actually going to do with it. I think on the system we probably say max cash out is $1 million, but that just means that if we do more than that if it makes sense. It just means that $1 million means that it's actually limited to certain people with the right delegation that can actually approve that. So we do over $1 million. But yeah, so I touched on before about the fact that we're going to introduce stat dec or client letter, where it becomes really difficult for clients to provide something specific. There is also existing guidance in our cash out policy where, and use an example, say they're asking for $400,000 in cash out, and they can prove 350,000 of that in the last bit. We also allow the analysts to have the flexibility just to waive that and move on. So there are some things that we've got in place, but that's our basic cash out policy.
Great, thank you, Dave. Graham had a question about pre-approvals being fully accessed. I think we've answered that one. How does AMP view bonus and commission income? Dave, I think it's not one for you.
So commission is typically discounted by 20%, and bonus income we'll do a 20% discount up to 50,000. Anything that exceeds 50,000 is then discounted by a further 50%.
Thank you. This is the last question I've got here, and so again, if there's any other last questions, this is your last chance. Again, Dave, it's for you, Mr. Popular. Do you decline a case only because of a low credit score?
No.
There you go. Straight and to the point. All right, folks. I'm looking at the questions, and I think we've answered all of these. So thank you so much for all the questions that have come through. Great questions, and a couple of things there for us to think about, and a couple of things there for us to come back to you on as well, particularly around the maternity leave income on sole traders. And so if there aren't any other questions, I'm going to wrap it up, and I'm going to say thank you. Thank you for joining us. Hope you enjoyed the program that we put for you together. We really appreciate your time. I know the market is incredibly busy at the moment, and capacity is a real constraint. And so thank you so much for joining us. Really appreciate it. Really appreciate your questions. As Dave mentioned, we will be sending you a survey soon, and we really value your feedback. If there's anything that you would like to see more of in these types of sessions, please let us know in that survey. And of course, if there are any queries that you have, please contact your BDM. But for now, we'd like to say thank you and enjoy the rest of your day.
Thank you.
Thank you.